The crisis began with a wave of decisions that shocked international students and exposed the new reality of studying in Britain. The University of Manchester reportedly issued termination letters to thousands of international students on the grounds that they could not prove a very large amount of financial backing, not simply income, but family wealth. The message was clear. Access to UK education was shifting from merit and ambition toward raw financial capacity. Almost immediately after, Edinburgh University announced a major reduction in international admissions, signaling that this was not one university acting alone, but a broader institutional response to changing visa rules, financial pressures, and political signals from the state. As these announcements landed, the property market, especially in university towns, reacted sharply. Reports citing Zoopla suggested that values in student-focused rental properties had fallen dramatically since January, a drop large enough to alarm landlords, banks, and local councils. The reason was not hard to understand. Large numbers of investors had borrowed heavily to build or buy accommodation designed specifically for international students. When the flow of those students slows, vacancy rises fast, rental yields fall, and property values start to unravel. In many towns, this is not a small correction. It becomes a structural shock because student tenants are the foundation of the local rental ecosystem. International students do not come as single economic units. They come as communities. When an international student leaves or chooses not to come, that decision often carries dependence with it. If hundreds of thousands of students decline UK offers or are forced out by financial requirements, the impact multiplies into a population-level exit from the housing market. That means fewer renters for HMOs, fewer tenants for purpose-built student blocks, and fewer consumers for businesses that rely on the term-time economy. This is why the issue cannot be treated as just admissions numbers. It is, in effect, a demand shock that removes a large segment of residents from specific cities almost overnight. International students support far more than university balance sheets. They rent homes, buy groceries, use public transport, pay utility bills, and sustain local employment in retail, hospitality, and private housing management. Their spending does not remain inside campus walls. It spreads through local supply chains. In university towns where students represent a major portion of renters, their presence inflates rental demand across entire neighborhoods, lifting yields for landlords and strengthening local business income. When that population shrinks, the immediate result is falling rents and rising vacancies, but the deeper result is a slowdown in the entire microeconomy that had formed around student demand. The collapse hits hardest where student housing is concentrated. In some cities, students make up a large share of renters, and in those areas, landlords depend on predictable annual cycles of demand. When that demand breaks, the market does not adjust smoothly. It breaks downward. Reports from landlords describe sharp vacancy spikes, rent reductions, and sudden competition among property owners who previously had waiting lists. Homes that were optimized for groups of students, multiple small bedrooms, shared bathrooms, minimal living space, become difficult to rent to families, meaning the exit route for landlords is limited. As more owners try to sell into a weakening market, prices fall further, dragging down nearby values. Universities are now confronted with a severe income gap because international fees have been a major part of their financial model for years. When applications fall, universities cannot replace that income with domestic students because domestic fees are lower and domestic numbers are not rising fast enough to fill the gap. This creates a structural funding shortfall that forces universities to consider staff cuts, course closures, reduced services, and even mergers or closures. Many institutions are reluctant to admit this publicly because confidence matters. A university that appears unstable risks further losing applicants, donors, and investment. But the internal pressure becomes visible through hiring freezes, redundancy programs, and emergency budgeting. Student accommodation is not just housing. It is a specialized asset class built around the assumption of consistently rising international enrollment. Purpose-built blocks, private halls, and converted HMOs have been financed on projections of high occupancy and premium rents. When the flow of international students slows, the maths fails quickly. Vacancy rates rise, rents drop, and valuations fall. Once valuations fall, lenders become nervous, refinancing becomes harder, and distressed selling begins. That is how a student housing downturn can turn into a wider property risk, especially in towns where student housing makes up a major portion of rental supply. Major issue is that student homes are not easily repurposed. HMOs and student blocks are designed for short-term occupancy, high turnover, and shared living. Families usually want different layouts, fewer bedrooms, more living space, privacy, parking, and long-term stability. Converting these properties can require expensive renovation and planning permissions, and even then, the location may remain unattractive to non-student tenants if the area's infrastructure and reputation were built around student life. That means many owners are stuck. They cannot rent at previous rates, cannot easily convert, and may be forced to sell into a falling market. Central driver behind the crisis, according to this narrative, is the rising upfront cost of coming to the UK. Maintenance fund requirements, health surcharges, and rising tuition mean students must prove large sums before they even arrive. This changes the profile of who can study in Britain. Middle-class students from countries that previously made up a significant share of international enrollments may be priced out. When those students go elsewhere, to countries offering lower barriers or clearer post-study work routes, the UK loses not just tuition income, but long-term reputation and demand. Once trust breaks, recovery is slow, because future students follow the choices of older cohorts. The UK's international student intake continued to fall in 2025, with overall enrolments down 6% after a 20% drop in 2024. International postgraduate enrolments also declined by 6% year-on-year, including a 17% fall in Chinese students and a 9% drop in Indian students. The decline is being felt across the sector. 61% of universities reported fewer international postgraduate starters in September 2025, marking the second consecutive year of falls. Universities warn the trend could worsen financial pressures, as many institutions rely heavily on international postgraduate fees. Another major factor is uncertainty around post-study work. For many students, the ability to work after graduation is part of the value proposition. They pay higher international fees, not just for education, but for the opportunity to gain experience and recover some costs. When that pathway is reduced, reviewed, or perceived as unstable, students begin comparing alternatives. Countries like Australia, Canada, and the United States offer more attractive or clearer post-study work options, which strengthens their appeal. When Britain appears uncertain, students choose stability elsewhere, especially those who must justify large investments to their families. Impact is not evenly distributed across the UK. Some regions depend heavily on universities as economic anchors, especially cities where international students are a major part of spending and rental demand. In those areas, the student economy supports jobs, transport, small businesses, and even city centre development plans. If international student numbers fall sharply, councils face reduced economic activity and potentially reduced tax base, while local businesses face reduced demand. This is how an education policy problem can become a regional economic crisis, affecting people who have nothing to do with visas: shop owners, staff, landlords, contractors, and service workers. What emerges is a chain reaction. Policy changes reshape student demand. Falling demand hits housing. Housing losses squeeze landlords and banks. Universities lose revenue. Cities lose economic activity. Whether one agrees with the politics or not, the economic mechanism is straightforward. Remove a large, concentrated population from local markets, and those markets will contract. The long-term risk is reputational. Once students decide a country is unwelcoming or unstable, they do not return quickly, and neither do their siblings, friends, or communities. The result is not a temporary dip, but a generational loss that could reshape Britain's education and property landscape for years. University towns seeing general property prices fall 15 to 25%. Contagion effect. First-time buyers can't buy student areas. Oversupply crushing prices. Buy-to-let investors fleeing market. Cash buyers only at massive discounts. Right move hiding the carnage. Removed 40,000 student property listings rather than show true price drops. But the data leaks. Southampton down 23%. Nottingham down 28%, Leicester down 31%. This isn't correction, it's collapse, and it's spreading outward from university towns.